Welcome to the Independent Financial and Property webinar. Today we are going to be talking about how you can pay off your mortgage completely and how to buy 7 properties in 10 years or less. Now we aren't going to weigh you down with all the jargon, but what we are going to do is give you the facts and figures so you can make your own mind up. Make your own decision about the kind of life it is that you want to have. Thanks for joining us here on this webinar, and we hope you will find it informative, but most of all we hope you will find it profitable. Wealth creation used to be something you left to the bankers and to the corporate types, but things have changed. Information was once only available to professional investors. Now it is available to all of us, and this information means anyone can create the kind of security, the kind of lifestyle, and the kind of future that really does make a difference. First, let me tell you about Independent Financial and Property. We are property professionals with over 60 years of combined experience in real estate, property development, and in finance. We provide our clients with a personalized, comprehensive property investment service. You get to access the same experts and at the same high level as we do. You get to take advantage of our own strategic business alliances. These are alliances that we have built up over years in the business and include top licensed professionals in real estate, financial services, and in property development. One of the other things we do is to use our expertise to look at what areas are destined to perform in the marketplace. We take independent information, we break it down, and then we help our clients understand where they should be investing, and just as importantly, why they should be investing. We offer the knowledge, we offer the training, the support, and the proven strategy to get the mortgage monkey off your back and to secure a future that is bright, a future full of possibilities. I want you to understand what we are not. Independent Financial and Property are not accountants, not real estate agents, not financial advisors or solicitors. This means we are totally independent, but we use all of their expertise and knowledge to show our clients how to get the best financial advantage. Part of what you learn with Independent Financial and Property is how to break through all that jargon and get the independent professional advice that you need to build the future you want by making informed investment decisions that are just right for you. Let me tell you what we are going to cover in this presentation. I know that a lot of things I want to talk about today may challenge your current underlying belief systems about money, about investing, and about ownership. Well, that's the first step on your own incredible journey to genuine financial freedom. Firstly, we are going to go into the myth of the property bubble. Then we will see the difference between being proactive or reactive to economic events, and then we will learn from the lessons of history and how to turn those lessons to our advantage. Next thing we are going to cover is how research is the key. We will learn about the value of research and about the 3 things that A-grade investors look for. We are in the business of selling assets. All investors are actually just people who hold money in a certain asset class. In our case, that asset class happens to be property. Really, to become a successful investor, you need to be up to speed on finance and you need to understand debt structure and asset protection. Do not worry if this all sounds a bit complicated. Really, it is not complicated, and you will see how simple it becomes when we cut through the jargon and we explain it to you properly. By the end of this webinar, you will understand that finance and structure are the reasons you invest in property, and property itself is merely a wealth creation vehicle. Then we are going to move on to understanding how the property cycles operate, how to find the information that puts you ahead of the game, and why you may just have to rethink the old investment myths. Finally, we will cover the nuts and bolts and tell you how you can win in the world of finance. We will tell you what we can do to help and the proven painless practical way to get started. I am going to show you how to build a structure, how to invest in a property portfolio, and how to retire on a passive income of about $80,000 a year in just 10 years or even less. Let us get started with a question we get asked by many people who are deciding whether property investment is their best method of wealth creation. And the question is, will the residential property bubble burst? To answer this question best, first we need to take a little history lesson. In the 1960s, we emerged from a major credit squeeze, finance dried up, there was the Cuban Missile Crisis, and American President JFK was assassinated. After each of these events came the question, will the residential property bubble burst? But here is a better question. If you inherited a portfolio of 7 properties bought in the 1960s, where would your holiday home be? In the 1970s, we had a recession, high unemployment, rising inflation, and the stock market lost 40% in 18 months. And after each of these events came the question, will the residential property bubble burst? Here's a better question. If you now own a portfolio of 7 properties bought in the 70s, what kind of boat would you own? In the 1980s, we had a recession. We had high interest rates. We had peaking inflation. We had a stock market crash and fear of recession. After each of these events came the question, will the residential property bubble burst? Here is a much better question. If you had invested in a portfolio of 7 properties in the 1980s, where would you be going on your next vacation? Let's look at the 1990s. 11.3% unemployment, record foreign debt and current account deficit, world economic slowdown and the Asian currency crisis. Even more recently, in the 2000s, we had September 9/11. We had the subprime fallout and, of course, the good old GFC. After each of these events came the question, will the residential property bubble burst? Here is the crucial question. If you built up a portfolio of 7 properties buying in the 90s or even in the early 2000s, how would it feel today to have total financial freedom for you and your family? The fact is, the property bubble question is asked every year. The most important thing to understand is that for the next 10 years, there is going to be things that are going to happen in the property market. All these things are just events. They are events that happened, and they will keep on happening from now until the end of time. The thing is, as an investor, you can either be reactive or you can be proactive. 95% of people are reactive, only 5% proactive. The difference is very simple. It is the knowledge you have and how you use it. That is all it is. 95% of people do not understand how to do correct analysis on property. When the market is going left, they go left. When the market goes right, they go right. When everyone is selling, they sell. When everyone is buying, they buy, which usually means that they buy at the peak of the property cycle and then they overcommit financially, and then they have to sell it at just the wrong time, so they lose money. We are talking about 2 different types of people here. Educated, savvy investors and the average person who speculates. Average people who speculate do not have a particular system. They basically buy and sell depending on which article they have just read, or what their friends are investing in. Whereas your educated investor sticks to a very strict system and knows exactly how to do due diligence on the property market. And they research which areas will go up regardless of market sentiment. Look, if you only take one piece of vital information away from this webinar, this is the one. If you want to create wealth and secure your future, then you need to become an educated investor. Someone who actively responds to events seeing the opportunities rather than the average person whose knee-jerk reaction loses the money and keeps them in debt. It is also about overcoming fear and going for the investment. It is all about buying assets that make you money rather than liabilities that cost you money. It is about using positive debt and borrowing in a good way rather than carrying bad debt that just drags you down. Another thing the educated investor knows is how to legally reduce their tax bill. They get expert advice instead of listening to the guy in the pub, however good their intentions. The educated investor works smarter, not harder, grabs opportunities when they arise, and makes the most of their time. Here's the biggie. The big difference between an educated investor and the average person is they take action. They make it happen. Where does the educated investor start their education? If you want to know what is going to happen in the future, it is usually a very good idea to take a look at the past. Have a look back over the last 100 years. We will use Sydney as an example, but you can use any of the major capital cities, and the result will pretty much be the same. 2 things to notice here. Look at the trend. Over the long term, it is only moving in one direction. And look at what happened when 2 devastating global events stopped that trend temporarily. There was the Great Depression and then World War II. When those events ended, the upward price trend continued as if those events had never happened. How about analysing the growth in property prices more recently? These figures give the median growth for every decade since 1942. When, if you had invested in property with a 10-year plan, you'd have seen an incredible 259% growth rate on your assets. Or how about if you had started in 1972 and seen your investment grow by an amazing 291% over the following 10 years? The thing is, even in the worst performing decades, you were still getting a respectable return on your investment. I'm going to say this slowly so you can let it sink in. In 1960, you could buy a house in Sydney for $8,200. To buy that same house in 2006, would cost you $397,500. Now this is interesting. If you had bought a property in 1960, you would have doubled your money in 12 years. But back in 1972, you would have doubled your money in only 3 years. Investing in 1975, it would have taken 8 years. And buying in 1988, you would have doubled your investment in 13 years. The question is not if you will double your investment, it is when. You can see the figures. You can see how it is possible to create wealth using a property portfolio strategy. You might now be asking why, when the evidence is this clear, why is everyone not doing it? The statistics are frightening. Out of 100 people born, by the time we reach 65, 15 of those will have passed away. 74 of those people will be welfare dependent, and 7 must stay at work after the age of 65 just to survive. Only 3 will be financially secure, and only 1 will be really wealthy. These are statistics from the Australian Bureau of Statistics. It is pretty damning really, because I suppose a lot of us do not think of planning ahead for the future. A lot of people invest too late in life and are not left in the best position for retirement. What we need to do is really understand the concept of investing. We need to embrace it, whether we like it or not. It is really about being smart with our money and putting it into areas which are going to give us financially secure old age. Why is it that over 98% of Australians aged over 65 retire completely broke? Is it the way we think about money, or did we just never learn how? Wealth creation isn't taught in school, or maybe we are all just too lazy to educate ourselves. Or is it because getting started is really the hardest part? Or is it because we think we left it too late to really make a difference? Or is it the fear of borrowing that stops us? Most people let the fear of being in debt stop them. Whatever the reasons, these are the uncomfortable facts. 40% of adult Australians earn less than $400 a week. In other words, they're broke. A massive 70% of adult Australians earn less than $675 a week. And only 2.2% of adult Australians earn an above-average $100,000 a year or more. If you need a reality check in a nutshell, here it is. 81% of us, who make it to 65, live on $400 a week or less. They rely on the pension or their families and eke out a very modest existence, living on or below the poverty line. Only a very few, only about 5% of us who reach 65 have a golden retirement with $1,000 or more a week coming in and are really able to enjoy that final third of their lives. So why do most Australians fail financially? I would guess no one sets out to fail financially, but the figures are pretty damning. There are 2 main reasons most Australians fail financially. First, they fail to plan. Now, if you were going on a holiday weekend away, you would not just jump in your car and blindly start driving, would you? Of course not. Before you leave, you would have booked your accommodation, packed your clothes accordingly, arranged time off work, budgeted your money and your time, and looked at a map to see the best way to get to your destination. If this is the planning you need just for a weekend away with the family, then surely the rest of your life might need a bit of planning, wouldn't you agree? But unfortunately, the old "she'll be right, mate" attitude is what most Australians adopt and ultimately fail financially. The second reason most Australians fail is they fail to start. You see, investing is not a new or original idea. Most Australians know that to become financially independent, they need to invest, but unfortunately the majority never make the effort to get the right information and never start. Let us take a look at what the savvy investor does that the average person does not. Over their lives, the average person goes to work to earn an income. There is nothing wrong with this. We all need to earn money. Then once they earn the money, they spend a bit, save a bit, spend a bit, save a bit. And if you saw the average person's bank account, that is how it would look. And ultimately, they end up on the pension. That is what the educated, savvy investors do. They too go to work to earn a wage, but instead of spending their wage, they save it and invest in assets, so they can retire with lots of money. Now, you did not need to watch this webinar to learn that. You already knew that. But to know and not to do is to not know at all. You see, information without action is useless. So what we hope to do is help you discover what is the one thing that has been holding you back, the thing that is stopping you from achieving your dream in life. But more on that later. Right now, I am sure you're asking the question, okay then, what exactly is an asset? Well, to answer this question, we are going to go to one of the best wealth creators in the world, the author of the book Rich Dad, Poor Dad, Mr. Robert Kiyosaki. You see, Robert quite clearly points out in his books that an asset is anything that goes up in value and produces an income. Robert Kiyosaki believes it should be everyone's goal in life to build their very own asset portfolio of things that go up in value and produce an income. Robert is very strong that if it does not produce an income, it is not an asset. You will see he understands that. One day, you will need to live on a passive income when you can no longer go to work. I want to share with you the 3 key things that A-grade investors like Robert are looking for in their portfolio. Number 1 is capital growth. We need an asset that is going to increase in value. Number 2 is income. We need a regular return on our investment. Number 3 is being able to duplicate that process in order to grow the portfolio. I think by now you are beginning to see that residential property is an asset class that easily fulfills the criteria. Let us talk about the first of these 3 vital facts: capital growth. Getting in on an investment just as its value is about to soar is all about timing. You need to time your property purchase just right in order to profit from maximum capital growth. We are talking about timing. It is appropriate that A-grade investors refer to the property cycle. Neighbours who only bought their houses a few years apart discover that although property values have soared, one of them has a substantially bigger slice of equity than the other. It is all about timing, making the property clock work for you. People who just do not get this will try and tell you that the buy and hold property strategy is just too slow. But that is a complete myth, and I will be showing you why. Property cycles usually run peak to peak every 7 to 10 years, but for as much as 2/3 of that time, it could seem that not much is happening price-wise. Then all of a sudden, in the last third of the cycle, you get a spurt of growth as the property goes from a stable market to rising market and then a boom market. If you were buying at rising stage in the end of the cycle and re-evaluating at boom end of the cycle, you were going to see some pretty healthy returns. The educated investor has the discipline and the knowledge to focus on these growth periods so that their portfolio experiences outstanding capital growth. Once you understand property cycles, you can see how another property investing myth is completely busted. Sure, buy and hold is slow if you are buying and holding without doing your research, or if you do not do the necessary analysis on where you are buying. Let me show you how to speed up your wealth creation exponentially by applying knowledge in just the right way. Once we understand that property values move in cycles, we can use that knowledge to create wealth. This is how we multiply our portfolio. We have multiple cycles all over the country at different stages of the cycle working to create our wealth for us. The way to make this work incredibly well is to have a diversified portfolio of properties. That means having a variety of properties in various states. Some have just been through the boom stage and are waiting in the stable stage. This way, you get the benefit of multiple cycles. You have a number of different properties in your portfolio, each at different places on the investment cycle. Unfortunately for us, there are multiple cycles happening throughout Australia all the time. That means there are opportunities for us to expand our portfolio all the time. For example, if after doing our research we were to find an opportunity in Sydney, we can use the growth in, let's say, our property in Perth to finance the purchase and get in at just the right time. This is just the logical progression in building your portfolio. You use small deposits of equity, little or no holding costs, real numbers, and smart decisions. And you do your research so you get the timing just right. It is a low-effort input and very time-efficient investing strategy, working smart, not hard. Now we are going to look at what creates a rising property market. The important thing here is to identify what drives this great increase in property prices and how to understand how these factors interact. Where we see demographic growth and economic growth, we know there's a strong economy in that particular market. A growing economy drives job creation. Job creation pushes wages higher. Higher wages means higher real estate values, and a thriving real estate economy, which in turn gives us increasing rental returns. We need to identify key drivers like infrastructure spending, demographic life cycles, social dynamics, and investment, both by government and private enterprise. Spending on better roads, better transport, better schools and better hospitals is a good indicator that this area is destined to grow. Other key drivers include population increase and an expanding jobs market. What Independent Financial and Property does is to teach the educated investor how to use this data, how to apply the relevant criteria, and how to quantify growth potential within strict and very profitable guidelines. What we have to fight against here is making investment decisions based on assumption and emotion. The educated investor learns to rely on the facts and figures, and of course on detailed analysis of those facts and figures, rather than on guesswork or what we think we know. This is about being in control of your finances and in control of your retirement. It is about making clever decisions. You need to be controlling the numbers unemotionally, implementing the plans that are going to turn into a really healthy retirement. We have already touched on this before, but I want to emphasize here that building a property portfolio and creating life-changing wealth is not about buying pretty bricks and mortar or buying into the fashionable new parts of town. The key success factor is the ability to leverage your investment by effective financing. In other words, you need the banks to say yes. Let me explain. Positive and negative gearing are just finance industry terms for whether your assets are making you money or costing you money. Here is an example of negative gearing. Your $400,000 investment property is costing you more to own than you are getting in rental income and tax back. In other words, you are losing money. Your shortfall is $50 a week. But if your $400,000 house is giving you a rental income in excess of your costs, you have positive cash flow and positive gearing. In this example, your investment property is earning you $50 a week clear profit. Now, in order to maximize your profits and minimize your costs, the next part is one of the most important things to understand. You see, one of the key areas of property investing is the tax advantages. The wonderful Australian government will give us our tax dollars back if we are using our money to build an income-producing investment portfolio. Let us look at this example below to better understand how to maximize our tax advantages. Here we have two houses which are in the same street. They both get the same rental income and they both cost $400,000 to buy today. However, one is brand new and is a bit boring looking, just a simple square home with a brick letterbox. The other is a beautiful character house that is 20 years old. It has a white picket fence and a lemon tree in the front yard. Now, the Australian government allows us to claim back the depreciation on the cost of the building at 2.5% a year for 40 years. And for this example, let's say 50% of the price was for the land and 50% was the cost of construction. On the new house, it is easy. The cost of construction would have been $200,000. But with the 20-year-old house, we need to first know how much it was built for, now given the houses have doubled every 7 to 10 years. If we work it back, say 10 years ago, it was worth $200,000. Then 20 years ago, it was worth $100,000, which would be about right. That means if we go 50-50 house and land, the cost to build the 20-year-old house was only $50,000. Which means that the tax deductions for a property we bought for the same purchase price as the new property would only gain us $1,250 per year in tax deductions, whereas the new property would gain us a massive $5,000 worth of deductions per year. But what happens is people buy with their heart and not their heads. They see the white picket fence and the lemon tree and they fall in love with the 20-year-old property, and ultimately cost themselves $150,000 worth of tax advantages. Now, if you only took the smart piece of information away from this webinar, you would be far ahead of the average investor. But if you get that concept and couple it with the next subject of gearing your money, then you may just be on your way to financial freedom. So what is gearing? Gearing is using a small amount of your money and leveraging it into a large asset. You see, the educated, savvy investor uses as little of their money as possible. Instead, they use the bank's money to help them get wealthy. If we take the example we just spoke about and assume we buy an investment property that has a shortfall of $50 per week, and we gear that money into a $400,000 investment property over the next 10 years, to hold that property you would have invested $26,000. Now, assuming you have done your research correctly and bought in a high growth area, that property will double in 7 to 10 years from $400,000 to a whopping $800,000. Now, if we sell that property in 10 years, we would have to pay back the bank its $400,000 as we held the property in an interest-only loan, minus our investment of $26,000. That means our profit of the investment property is a very cool $374,000. Now, what I know about most people is that you could find $50 per week, but I also know most likely you could not save $372,000 in 10 years. That is how we make a profit from our growth. But what about the other factor in all this? Managing our debt obligations. By now, I am sure you are aware that in order to invest in property will require a certain level of debt. What I'm going to show you now is the real game changer. I'm going to show you how you could eliminate your mortgage in under half the time. It all starts with a thing called an offset account. Now, an offset account is a wonderful financial tool offered by most of the reputable financial institutions and big banks, sometimes also referred to as a redraw facility. You see, an offset account is the same as your everyday savings account, but with one big difference: it is linked to your mortgage. How it helps you pay down your mortgage faster is because for every dollar you have sitting in your offset account, the bank reduces what you owe on your mortgage by that amount for as long as it is in your offset account. For example, if you put $4,000 into your offset account in this example, it would lower your mortgage balance down from $100,000 to just $96,000. Why does this help, I am sure you're asking right now? It helps because the interest component of your loan is charged on the daily balance of your mortgage. So if you put $4,000 into your offset account, you will only be charged interest on $96,000 rather than $100,000. Therefore, when you pay your mortgage repayment, you will be paying more off your principal and less in interest. Now, where this really kicks into overdrive is if you go get an investment property. You see, when you get an investment property, you start to produce cash flow in the form of rent and your tax back. Now, this money comes in weekly, but your mortgage is not due until the end of the month. So what you do is save that money in your offset account on your mortgage, which will drive the daily balance down so you get charged less interest, reducing the amount you owed the bank much faster. Now, if it works this well with one investment, then it's just a case of how many times can we simply duplicate the process. You see, you only need to understand how it works once, and then it is as easy as doing it again and again. McDonald's, for instance, only had to figure out how to make a great burger once, and then they just duplicated it over and over again. They didn't create the first Big Mac and then try and reinvent the wheel. You see, once you put in the effort to learn the strategies of wealth creation just once, it is simply a matter of how often you can repeat it. And just as a side note, did you know that McDonald's is actually the largest owner of real estate in the world? Fact is, they make more money year in, year out from their property than they do selling burgers. Now, I know you do not have billions of dollars to spend like McDonald's do, but what we can do is follow their successful strategy and make it work for us just as well. So once you have bought your first investment property, you are now using your extra cash flow to pay down your debt at a rapid pace. When you have accumulated enough equity from both the price of your investments going up and your debt level going down much faster, you can look to leverage that equity to buy another investment property. We leverage our equity and use the bank's money, so over the next 7 to 10 years, as you can afford to, you build your portfolio until you have got your own home, plus 6 or 7 investment properties, all working for you to produce that magical cash flow. Now stay with me because I can hear you thinking, yeah, but how am I ever going to get rid of all those mortgages? Well, this is the exciting bit. You see, once we have completed the accumulation phase, it is time to start planning for our exit phase. We work out how much capital growth we have accumulated. And when the numbers are right, we liquidate by finding the 2 properties that have performed the best, and we sell those properties. Now, because we have been paying down our debt at a much faster rate, we can use the money to make on the sale of those properties and pay off what we still owe on the other investment properties, leaving you with your own home plus 4 investment properties owned outright. Which means, if we work on the average rental income in today's market, you would be living on a passive income of a whopping $89,300 per year, which puts you right up in the top bracket of all people who retire in Australia. Now, if that wasn't great enough, consider this. As you own these assets outright, your personal wealth could be valued at an amazing $3 to $4 million and rising. That's right. In 7 to 10 short years, your personal wealth would be an incredible $3 to $4 million. Now, I told you at the start of this webinar that I was going to show you how you could break out of the financial rat race and create a truly financially free lifestyle. And I think we have done that. But what's the next step, you ask? Well, the next step is to align yourself with the right experts to help you achieve this. And I do not mind saying that we at Independent Financial and Property are experts. How do you take the first step to becoming a successful property investor? It is really simple. You become an Independent Financial and Property Premium member and join our coaching program. Let me show you how our members-only coaching program takes you by the hand and guides you through the first steps to becoming an educated investor. Step 1 is where you meet your coach. If you live in a city hub, you will meet face-to-face. If you are in a regional town, you will have regular calls and online meetings. It is an easy introduction and a friendly way to get to know you, where your coach can get to know more about your unique situation and discuss your future goals and talk about any obstacles that might be stopping you from achieving them. You will get more detailed information on what is involved in becoming a successful property investor and get full and frank answers to all of your questions. It is also an opportunity to go through a simple fact-finding session, so we have got an overall snapshot of your financial position ready for your strategy meeting with one of our finance professionals. In Step 2, understanding how your borrowing capacity result sets the parameters of your financial goals. We will discuss becoming market savvy, planning your targets, understanding your ideal property type, and reviewing your best financial structure. Step 3 takes you into research and reporting, identifying property types that exactly match your financial criteria. The search will be on for your very own rising hotspot, and you will be getting full and straightforward information on how to read and use relevant data. The best thing about having your own personal coach is that it is easy to ask questions and get answers throughout the process. Our expert property mentors are all property investment enthusiasts who know what it's like to be in your position. Then, in Step 4, in-depth property searches explore possible properties that fit within your criteria. With full data analysis including extensive reports, market trending, and exclusive access case studies and projected growth results. This is where you will really begin to become an educated investor. This level of detail and research sets our premium members ahead of the pack, able to make intelligent and savvy investment decisions based on the cold hard facts and figures, and just what those facts and figures mean in your wealth creation strategy. Imagine the huge advantage of Step 5, actually having an experienced coach and mentor to help you step by step through every single stage of the purchase process. You will have support and advice you need, and even after your purchase is made, you'll have all the assistance you need to manage and maximize your profit from your investment property. Best of all, your coach then follows up to help you stick to the plan along the way. They are there for guidance for your following purchases and ensure you can complete your strategy all the way through. You see what it means to have your very own personal expert just a phone call away. The confidence you will gain from having a team of experienced professionals behind you is priceless. And that puts you way ahead on an exciting journey to financial freedom. This is what you get with the Independent Financial and Property Portfolio Builder Coaching Program. As you can see, the total value for the meet and greet, preparing your personal strategy, research and reporting, finding property deals, helping you make your purchase, and following up with your future is only $5,200. But I promised you something special at the beginning of this presentation. Now I can reveal the exclusive time-sensitive deal we have got for you today. Take this opportunity now, and your $5,200 value will only need an investment of $297. I'm just going to let that sink in. A $5,200 value program for only $297. I know that many of you are thinking, well, how can it be such incredible value? How do you make money? It's a great question. Truth is, $297 is an administration charge, and that is why we have to limit this incredible deal to only the first 15 people who apply this week. But we understand the value of building relationships, and in the future, you will recommend us to people who would also like to learn how to create true financial freedom in their lives. At Independent Financial and Property, we see this as a way of giving back or paying it forward, if you will. And we have found that by doing this, we have managed to build a company that is built on lasting relationships with our clients who end up becoming almost like family to us. Now, when this membership phase is full, we will have to start charging the full program fee. As part of the membership, we offer these added bonuses. To make this an absolute no-brainer, for the first 7 people to take up the Portfolio Builder Coaching Program right now, I'm going to offer some absolutely invaluable bonuses. Bonus number 1. Property investment can provide some great tax benefits if structured correctly. So we will help you find out whether your property should be bought in your name, joint names, family trusts, property trusts, or even a super fund. You will discover that the most tax-effective structure is for long-term protection and maximum wealth creation. You probably already know that self-managed super funds are becoming increasingly popular, and that is for a good reason. They're a great vehicle to use when investing in property because of the better tax breaks, but they're not right for everyone. With bonus number 2, you can find out whether you should have a self-managed super fund set up by meeting with our SMSF expert team. Bonus number 3 is a one-on-one meeting with our financial strategist team, to help you put a plan in place for the future that takes into consideration your current goals and the options you will have for positive future outcomes. With bonus number 4, a one-on-one risk management session with our specialist insurance advisor moves you on to the super investor level to keep your investments safe and positively protect your assets whatever happens in this increasingly uncertain world. These 4 incredible bonuses are valued at over $19,000, but are all included completely free of charge if you become an Independent Financial and Property Program member today, but only for the first 7 people to take advantage of this offer. Folks, investing in property is not difficult when you have the right people on your team working for your success. And that is the opportunity we are giving you today. Let me recap for you what is on offer here today. Firstly, we have the 5-step coaching program that guides you step by step through the property investment process to put you on the road to genuine wealth creation and a bright new future of financial security. This is an incredible program worth every cent of $5,200. Then there's the extra 4 bonus offers valued at $1,900. That's a total value of over $7,000. But you get this entire coaching program for an amazingly affordable $297. But to get the extra bonuses, you must act now and be one of the first 7 in line. If you wait and you're number 8, those bonuses simply will not be available. Now, to help make this decision a complete no-brainer as a very special offer, we will let you complete the first 2 steps in our program, the meet and greet and the personal wealth creation strategy, for free, and then decide after that if it all feels right that you want to pay the $297 and commence the full program. Wow! Talk about nothing to lose and everything to gain. That's $1,800 worth of value you get to try before you have to commit a cent. But for those out there who really want this but are still sitting on the fence, how about this? Not only can you complete the first 2 steps in the program for free, once you decide you want to proceed, pay your $297 and put us to work for you. If in the next 30 days, for whatever reason at all, you are not completely happy with the quality of work we have put in for you, we will give 100% of your money back, guaranteed. Now, if that is not enough for you to take a positive step towards a future you have always dreamed of, well, to be honest, folks, I am not sure what will. But if you are convinced that this is a path you want to go down and want to secure a life of true financial freedom, hurry and click the link below to book your spot in this life-changing program. And I look forward to speaking to you in person very soon.